What's up? Welcome to the live stream tonight. Give me a minute. Somehow or other my all right. I was just looking at BMNR options, selling $40 puts, which is I believe that's right around where the net asset value is. I think you get about 89 cents. That's pretty decent. Just for just over a week. All right, let me make sure my settings are okay. Hi, welcome. While we are waiting for people to stream in, I'm just taking a look at the markets today. I think what we are getting right now is a little bit of, yeah. I think the last couple of days have been rather flat, more or less. Even the down days haven't been too bad, and today it's slightly green, not too much. And I think people are just waiting for Nvidia's earnings to see how the market would react. I mean, I'm expecting Nvidia to deliver pretty strong earnings, and thereafter we'll see how the market reacts tomorrow. I don't think it will be as big a rally as people expect. I think we will still continue to drift a little bit higher, and then the Fed will cut rates on 16th of September. And I think after that, we can really see what the market thinks and how it's going to position itself for the rest of the year. Now, while I'm waiting for people to stream in, I just wanted to take a look at the BMNR option. So we are selling a 1 week out put at $40. Get about 89 cents per 40. That's 2% yield in a week. I mean, that's not too bad. And that's something that I'll definitely be considering. Hopefully the pricing's okay. Give me a second. Somehow or other with Weeble, I still prefer using the mobile app over the phone. So basically I closed out my SoFi options for end of week, which is 9th of August. So I had $20 puts. I'm pretty sure that SoFi is not going to get to $20 by this Friday. And the puts were worth around 1 cent. I sold half of them at around 1 cent, the other half at around 2 cents. And the reason is so that I can free up some capital to actually sell some puts on BMNR since it's coming down today. Yeah, I was looking at it yesterday, but because it was going up, the premiums were not as good as today. So if you take a look, the 9 days out, $40. From what I'm looking, it's up 54% just on the volatility today. You can get around 90 cents, I guess. Okay, that's between 80 and 90 cents. So let's just see. So I just sold 10 cash secured puts for BMNR on that expires 5th of September. So you can see the orders. Where is it? Yeah, the orders over here. We're waiting for it to be filled, right? 90 cents. Maybe I should. Yeah, and then we'll adjust it as we go along. All right, so in today's stream, we will be talking about another retail company that has been rather popular among people in the comments. Quite a few people have asked me to cover this company, and I was actually quite surprised to see, at least 3 or 4 people in the comments previously asking me to cover On Holdings. So On Holdings, basically it's a shoe company similar to Nike. They're in the sportswear and apparel segment of the market. And so today, it's day 7, I believe, of covering 10 stocks in 10 days. And we're going to be talking about On Holdings. So I'm going to get right into it, and then we'll just let people stream in. So if you do have any questions as we go along, feel free to ask in the comments section. I think the comments should be working. Every time I set this up, I always feel like I'm missing something. Just give me a quick second. Yep, if anyone is in here, you can just type in the comments to let me know that it's working, and then I will get started. All right. Okay, so today's company is basically On Holdings, or I keep calling it On and Ons because the ticker symbol is ONON, but it's actually On Holdings. I have to remind myself that throughout the stream today. So basically, when I was introduced to this company, I think it was because I was considering Nike and Lululemon. So I thought, let's just take a look at this company. And I'm going to take you through some of the research I have done and basically point out some of the differences between On Holdings as well as Nike and Lululemon. All right. So this company was actually founded back in 2010 by these 3 gentlemen that you see on the screen over here: Oliver Bernhardt, David Elman, David Allman, I presume. I hope I'm pronouncing correctly, and Casper Kopetti. Now, the reason behind the founding of this whole company was because the man in the middle, right, Oliver Bernhardt, he was a former triathlete, and he was always on the lookout for better running tech. And so, basically, since the birth of On, all 3 of them have been running the company at different levels, and even up to today, all 3 of them serve the leadership of the company within the board of directors. But the role of the CEO is now taken up by another gentleman, which you're going to see over here, Martin Hoffman. Okay, so Martin Hoffman, he isn't someone that is new to the company. In fact, he has been serving as the CFO with On Holdings since 2013, and he was promoted to co-CEO a while back now as a part of a transition of leadership within the company. You can actually see, he's someone that has been, sorry, where was I? Yep, he was promoted to co-CEO a while back. Now, during this recent transition, I think that's what I'm going to say. During this recent transition of leadership within the company, he actually became the sole CEO. And if you look at the history of what Martin Hoffman have done for ONS, he was essential in them scaling the early stage of their operations from a couple $100 million to over $2 billion of sales in 2024. And I think this is another case similar to what we have with Oscar yesterday, where the original founder had this understanding of where their strengths lie. And with Oliver Bernhardt, he knew that the company was much better served with him focusing on product development as well as vision casting, which is why I believe him, along with David Elman and Casper Kopetti, decided to take on board roles within the company instead and let other people do the running of the company. And so right now, I believe Oliver Bernhardt, he is leveraging on his background as a former triathlete to continue pushing new product innovation, new product design. And you're actually going to be seeing this later on quite in a very tangible manner throughout their valuation, right? And so I think what is really behind this whole brand is this thing called their cloud tech, which is a patented technology that they use to manufacture their shoes. Usually when I read such things, I actually, find it a little bit skeptical, like how much better can running shoes be. But I recently, hi, welcome, thanks for popping by. Yep. Yeah, so usually I'm pretty skeptical when I see people say that, or companies say that they have patented technology for running shoes. But I can't deny that recently when I was trying different pairs of shoes, I decided to try On only because I was asked to do some research about it, and I thought, why the heck not, right? And the moment I tried it, I'm not personally, I'm no not a runner by any stretch of the imagination, but the soles just feel different because I know like brands like Adidas and Nike have their own cushioning technology, but somehow with On it just feels different. And if anyone is a runner in the chat, you can actually let me know why is this so different. And so basically they develop all their shoes using this proprietary cloud tech cushioning technology, and I think to me it's something that at least I felt like I could tell a difference. It could be just me thinking too much about it. Because for me, when I look at businesses, I like to try out their products as far as possible. So when I was choosing my pair of shoes recently, actually just 2 weeks ago, I was at Adidas and I was at Nike. And after going to these two places, trying out their shoes, I was actually deciding between these two companies only. And it's only when I was walking back to the car that I saw it wasn't even a shop. It was just part of a retail, larger retail mall. It's just one segment in the retail mall. And I went over, decided to try their shoes because I was doing research about this company anyway. And I ended up buying their shoes on the spot because they were so much more comfortable than the two pairs that I was trying at Nike and Adidas. Unfortunately, right now, I do not have a Discord server. I'm still working things out on the live stream and get things a little bit more consistent over here. I think eventually in time to come, that's definitely the plan. But I think over the next maybe couple of weeks, I'm just focusing on getting the live stream right, getting into a proper cadence of putting out content on a regular basis, and then we will go from there, right? But I do acknowledge the interest. I think a couple of people have asked me about it. Something on my to-do list, especially towards the end of the year. So like I said, personally, I'm not a professional athlete or by any stretch of the imagination. I exercise pretty much on a daily basis, but at a normal person kind of intensity, right? So I from this point of view, I do feel that it is a lot more comfortable than the shoes I get at Adidas and Nike, but I can't tell you the specifics of what exactly about this shoe is actually so comfortable. So I guess there is some, in a sense, magic with their patented technology over there. But if you guys actually have tried on ONS before, you can let me know whether it really different or is this my mind playing tricks on me because I'm doing research on the company. But I think it's important to understand the business. Don't worry, you're not distracting me. It's all right. Yeah, I think it's important to understand the business of ONS, their positioning within the sportswear industry, because it is a very competitive space, and then how they are planning to provide value to their customers and shareholders as well. So they actually position themselves as a very premium brand within the industry. They tend to price their products definitely higher than your typical brands like Nike and Adidas. And they do, majority of their sales either through through direct to consumer sales as well as wholesale partnerships. And this is really no different from a lot of the companies that we see. Nike is taking on a similar approach, trying to grow their direct to consumer sales at the same time, also working with wholesale partnerships. And the partnerships they have with all the wholesale retailers basically is to help put their product in front of the eyes of more customers. However, when they focus on direct to consumer sales, they are able to generate a higher margin for the business, right? So like I said, this is a competitive industry in terms of the entire business. You manufacture shoes, you sell shoes, and you basically sell shoes through two main mediums, right? Either direct to consumer or through wholesale partnerships. So when I think if you look at the stock, so this is the cloud tech that they're talking about, and I do feel like it is much more comfortable. Like I was saying, I don't really understand beyond this why it's more comfortable other than it feels softer when I run. And I think what you can see is that because ONS actually positions themselves as a rather premium company compared to some of the other brands like Nike, what you're seeing over here is the gross profit margin. Oh my goodness, what's wrong with my English today? Gross profit margin of ONS as well as Lululemon and Nike. And what you're seeing is green and orange line at the top. Basically represents the gross margins of both ONS as well as Lululemon. And these two tend to price themselves in the premium sportswear category compared to Nike. And that's where you see that discrepancy in their margins. And I'm going to talk about how it affects their business later on. Right, so if you take a look at the share prices, this is the ONS chart. You don't really see as drastic a picture or a drastic drop compared to companies like Nike and Lululemon, which was why I was interested in those two companies in the first place. All right, so on a year-to-date basis, On and Ons, basically they're down 18% year-to-date. Nike is up 6.7% year to date, and Lululemon is down 45% year to date. And if you look at it on a longer time horizon, on a 5-year time horizon, ONS is up around 15.96%. Nike is still down 30% from all time highs, and Lululemon is down 46%. So I think companies like Lululemon and Nike have been hit by a downturn in demand, or at least what appears to be like a downturn in demand. But the issues surrounding ONS, which caused this volatility in the stock price, is slightly different. And I think, we really need to talk about the differences between these three companies to understand the thesis when we buy ONS. So around Lululemon, I think there are definitely fears of slower demand, especially in the US, contracting margins due to tariffs, and a buildup of inventory that they cannot move. I think people have complained that certain products from Lululemon have been declining in quality. And so because of that, I think the general sentiment around the company right now is quite bearish. And then management has lowered guidance, I believe. And that is why, on a 5-year basis, they are down nearly 50%. In fact, most of it was actually this year, right? So you can see even on a year to date, they're down 45%. With Nike, it's slightly different over here. Over a long period of time, over the 5-year span, they're down 30%. But on a year-to-date basis, they are the only one of these three companies that is positive on a year-to-date return. And I think that is largely driven by Elliott Hill coming back into the company, and he has started the process to turn around the company, and therefore it is up 6.7% year-to-date. I think that reflects a little bit of investor sentiment towards this company. Now, finally, with ONS, I think what you're getting over here is a mixture of fears around the various macro and valuation issues. I think coming into 2025, right, ONS was trading at a fairly high valuation. I believe, sorry. I really need to get better at going through my slides. Give me a minute. Okay, I have my reference over here, so I'll remember. So this is basically a news report telling us Lululemon declining sales. Same thing, Nike declining sales. Only difference between Lululemon and Nike is that Elliott Hill has came back. He has already put in place the things to turn around the company. But what I'm showing you over here is really, you can see valuation compression for On Holdings since the start of the year. The two points at the top for the gray and the blue graph represents the valuation in January. So back in January of this year, in 2025, they were trading at around 8 times sales and 130 times earnings. And so at the high, I think towards the end of January, they were trading around the $64 range. Now, since then, with the election of Trump, there were always fears around tariffs. And so the market started to price in a slowdown, a potential contraction of margins, and increased costs due to tariffs, right? Because a lot of their manufacturing comes from countries like Vietnam and Indonesia. And Vietnam was one of the countries that, was particularly targeted by Trump during the 4th April Liberation Day debacle. So during that same period of time, around April and May, I think they also announced the leadership transition. Previously, they had a co-CEO model, and they moved to a single CEO model. And I think due to the uncertainty around the possible execution risk of the new leadership, the market continued to sell them off over the next couple of months. But of course, during the most recent earnings, the share price actually popped once again. However, like I mentioned earlier on, the current CEO, Martin Hoffman, he's not someone that is new to the business. They did not pilot someone in to try and save the business. He has been someone running the business on the ground, firstly as a CFO, and he watched the business scale from just a couple $100 million to multi-billion dollars today. And I feel like he is someone that is basically, well versed with how the business is supposed to run, understands the culture of the company, and he's able to put in place strategies to really help the business grow in the long term. So finally, I think also at the same time, apart from all of these things, we also get weaker consumer data, and I think people are generally afraid of retail names when consumer data comes in weak, because there's it shows that there's a possible slowdown, a possible recession around the corner. I mean, everyone has been predicting a recession for forever, but it seems like it hasn't come yet. But if you consider these three companies that we're speaking about today, Nike, Lululemon, as well as ONS, I think you would notice that, two of these names, Lululemon and ONS, target the more, upper middle class, let's call it the affluent customer base. And I think, when you have to understand that this market positioning actually affects how they tide through the recession. Right? I think Nike, I'm not saying that Nike will not survive the recession. I think that Nike will definitely survive the recession just by the very fact that they are Nike, right? Because of their brand name, they have the staying power, they have proven it time and time again. But for smaller brands like ONS, I mean, Lululemon is no longer a smaller brand, but they are both premium, and ONS is a smaller brand. They are able to survive the recession because of cash flow and because of margin. And to do that, they actually have to target the higher income demographic of the population. So what you're seeing in this graph over here, right, is that this actually represents the excess savings by income cohort during coming out from the pandemic. So what you're actually seeing over here is that for people who are in the top 50% of the income cohort, they tend to be able to save more money and have more excess savings coming out from a recessionary time compared to the lower income people in the economy. And so because of that, as long as the company can tide through the recession, it could be 1 to 2 years, exiting from the recession, people in the higher income segment of the population will still have excess money to be spending on their products again. And that is why companies like On and Lululemon positioning themselves in the market is a very smart way for a smaller company to survive a recession because they have a much wider margin. So, if you look at the data from even 2008 to 2012, what you notice is that during a recession, you see these dips really in their spending power and as well as their income, but that will eventually recover. Now, this recovery might not be immediate. It's not necessarily a V-shaped recovery. That might take a couple of years. But what you're seeing over here really tells you why this company has a safety net despite the possibility of a recession. So if you take a look, what this actually shows you is how much the annual income of each segment of the population grew by exiting a recession. So in the bottom half of the cohort, what you are seeing is that the income for the bottom half of the population didn't grow as much as what you get in the top, maybe let's call it 20 to 40 percentile of the population, where the majority of income grew between 5 to 10% exiting the recession. So they actually ended up post-recession with a higher income compared to pre-recession. So I think beyond that, we also have to look at what management has been telling us about some of the concerns around the company to understand why the stock price has been so volatile. So in the first quarter of 2025, they actually mentioned that there's uncertainty over the US tariffs, especially surrounding Vietnam and Indonesia. But I think they also mentioned that they have built this into their guidance already. So this is not something that investors should be concerned about. I think the tariffs initially were proposed to be around 39-40%. And so I think right now, the implemented tariffs, the headline number is 20%, but there are certain segments of Vietnam that is still 40%, and I'm not sure whether that affects the footwear component. But if you listen to what companies say, this is something new. If you look at the last paragraph over here, this ever since ON exists, we have been paying around 20% import duty on the majority of our products imported into the US from our Southeast Asian manufacturing places. So tariffs is nothing new to these companies. An increase of tariffs between 20 to 40% is not something that is completely new to them. They have already had to contend with tariffs previously, and they're just able to pass the cost on to the consumer because they serve a much higher demographic. There's a lot more elasticity in terms of the spending power of the people that they're serving. And so because of that, they are quite easily able to deal with these headwinds, although these are structural headwinds that could potentially affect the business for the next couple of years until at least the tariffs are taken off. Now, I think that aside, later on, I'm also going to talk a little bit about some of the technology that the company is using from a more defensive approach to actually cut costs. So raising is an aggressive approach, it's an offensive approach to tackle some of these issues, but they're also taking a defensive approach by cutting costs. And I'm going to talk about how they do that later on. But I think another thing that presents a risk on the surface is actually, the difference between the US dollars and francs. So basically the foreign exchange rate. Oh, sorry, I think I'm missing that out. Over here, sorry. Later I'll go back to the couple of slides that I skipped. And I think as the US dollar weakens against the Swiss franc, I think that presents a headwind to their business, especially because they recognize a lot of their business from regions like the US and even Asia. And so as the Swiss francs strengthens against these other currencies, I think when you convert the sales in those regions back into the Swiss francs, it would actually appear as lower revenue, but that's not because they sold less products, that's largely due to the adjustments of currency. But if you look at how their business is structured, especially with a lot of the R&D spend and things like that, expenses being paid, those are being spent in Swiss francs, but they're earning revenue all over the world in different currencies. That's where you start to see this dynamic of the foreign exchange, and that's what you need to account for. And sometimes that can cause volatility in their earnings, which is why you're not going to see their earnings appear as beautiful as some other companies, right? So let me quickly go back to the slide over here, because one of the things that I want to talk about with regards to their earnings is that you can see the management team really has a long-term vision. So if you take a look at ONS revenue breakdown, over 80% of their revenue actually comes from footwear and apparel. But I think just by looking at it at that surface level, you're not really giving management due credit, because within this 80% of revenue that comes from footwear, they do have different verticals, which are basically made up of different brands of different segments of their shoes. That yeah, sorry. What was I saying? I lost my train of thought because I was jumping back and forth the slides. All right, okay. The next thing like I said, I really want to talk about is this 80% of ONS revenue coming from footwear, with apparel and accessories making up smaller segments of their revenue. Now, this is definitely going to continue to grow in 2025. However, if you just focus on this 80% of revenue coming from footwear, that's not giving management due credit, because I think they diversify their business not by entering into more segments of the market, but within that one vertical, footwear, they actually have 9 different footwear franchises, each making up more than 5% of their revenue, which means over close to 50% of their revenue is made up of 9 different shoe brands or shoe segments, or I think they call it franchise over here. And so I think you can see that they are finding ways to diversify even within the vertical. So initially, when you're talking about companies, the bigger companies like Nike, they tend to diversify within the whole sportswear industry. And you can see, okay, they do apparel, then they have basketball where they market their Jordans and things like that. It's all like within the broad category of sportswear. Whereas with ONS, they're very focused within footwear itself. They have 9 different franchises of shoes, each making up more than 5% of revenue. So if you put that all together, that's anywhere between 45 to 50% of revenue from 9 different lines of footwear. And that actually helps to diversify their revenue and makes it a lot more robust. And also, what you're seeing over here is that their revenue is also primarily driven by their direct-to-consumer model. In Q1 of 2025, 38% of their revenue was driven by their DTC model, and this has increased to 41% of revenue in Q2. Now, I believe as this mix of sales really goes towards the direct-to-consumer model, they're going to keep a higher and higher percentage of the margin. And so, like the whole sales segment of their business, I think as management has mentioned to us during some of the earnings calls previously, that a lot of it is an outreach to a tool to raise awareness about their product and to get their product in front of the eyes of more people. And this isn't too different from what the other sportswear companies are doing. But I think the one aspect of these sportswear business that people actually miss is the revenue split in terms of regions. I think people are a little bit afraid when America, which is the highest revenue region, starts to slow down or starts to decline. But I think they're not accounting for the fact that Asia might be a very big region as well, because she's seeing more and more adoption of this particular brand ONS. Initially, it's not as attractive, but I think especially in the last 6 months or so, I'm starting to see more and more people, especially people who are playing golf and tennis, actually, buy this brand more and more. And what you're seeing is that they're expanding their footprint in China. So, sorry. Yeah, so like I said, they were expanding their footprints in China. So if you take a look at their revenue growth by region, I think what you're noticing is that the Asia Pacific region actually grew sales by 101% year over year, with the Americas region only growing sales around 17% year over year. And like I said, I think because the American segment of the business is currently the biggest segment, people are a little bit worried. But I think Asia has a pretty big untapped market as well. And if you take a look at some of the recent news that they have released, ONS actually to open their 100th store in China by 2026, which is next year. That would include their flagship store in Chengdu. And so despite all the doom and gloom you hear about the China economy, you can't discount the fact that China is a country with over 1 billion people. And then you include foreigners from the surrounding regions, even in Singapore, because China has jumped to the number one most traveled to, it's the number one most visited travel destinations for Singaporeans. Foreigners go to China to shop and take advantage of, the perhaps cheaper currency relative to where they are coming from. And so these two things would definitely boost the sales growth in the Asian regions. And I must say that this brand is also starting to gain traction organically in Singapore among tennis players and golfers, surprisingly. So I think the Asian Pacific region is really being slept on, and I expect to see this region continue to contribute pretty strong earnings in the upcoming quarters. And so finally, I also want to talk about their recent miss in earnings per share. Right. Okay, and right now I also want to talk about their where was I? Oh, yes. Okay, so right now, I think at the end we also want to talk about their miss of earnings in the most recent quarter. Now, despite missing their EPS targets, the stock actually went up. And the reason for that is that because they hold a bunch of US dollars on their balance sheet, and as the US dollars weaken against the francs, they actually have to write that off against their net income. And so because of this, accounting accounting rules, let's say, accounting frameworks, that because of that actually posted a negative EPS. However, if you look at the fundamentals of the business in terms of sales, profit margins, and things like that, everything was healthy. The main reason or what caused this negative net income is due to the changes in foreign exchange. And so that is why when you look at the valuation later on, I think you should focus a little bit more on their gross margins rather than their net income and net margins, because this net income and net margins can be actually quite greatly affected by fluctuations in foreign currency, right? And so, like I was mentioning earlier on, I think one of the things that actually that help them to protect their business against rising prices is their light spray technology. And this light spray technology, I'm going to show it to you in this next slide over here. It's like how they have built out, various categories within their footwear. So basically this light spray technology that you're seeing over here is basically an automated system that actually helps them to manufacture their shoes. And I think just like how they built their business in a very defensive manner, having 9 different shoe franchises making up nearly 50% of their revenue. So they actually diversify even within the same vertical. This is also another defensive move by the company, because what the light spray technology does for ONS is that it helps them to strengthen their supply chain. Because right now, with this technology, they're able to move manufacturing back home closer to Switzerland. Because generally, the problem with manufacturing in the US or European regions is basically high cost. However, if they are able to automate a large part of their manufacturing process through light spray, then they are able to defray a lot of these labor costs and also ensure a more consistent quality. And I think one of the good things with the tariff announcement and things like that is that moving manufacturing back to Europe or even in the US, that is going to offset some of the tariffs, especially over the next couple of years. But I think it's important to remember that right now in 2025, this light spray technology is basically in the testing and optimization phase. And I believe we don't really see the global rollout of this technology until the end of 2026, going into 2027, which means the midterms would have been over. I'm not too sure what the tariff situation will be like by then. That's still over a year away. Right, but at least we know moving forward what this would mean is that ONS would have better control over their supply chains, and they're going to be able to put up stronger and more resilient margins. Now, if tariffs eventually go away, that means their margins could actually expand even more. But even if tariffs don't go away and they're managing to bring manufacturing into the US, bring manufacturing back home into Europe, then they are definitely going to be able to actually provide stronger margins for their business and basically create even more shareholder value. So with that, I just want to bring us very quickly into the valuation of the company. Right now, if there's any questions, feel free to ask me in the comments below. Otherwise, I'll jump straight into the valuation. All right, so on holdings today, it's trading at around $45.20. So you can see in the early part of the 2020s, they were growing fairly quickly in the 50s to 60% year-over-year region, and then that has slowed down coming into the last couple of years. Now, from 2023 all the way to 2025, you can see their growth has been hovering between 20 to 30%, only hitting 43% last year. Now, I believe this is after accounting for the effects of foreign exchange, because in the most recent quarter, despite their revenue today coming in their most recent quarter coming in at 32% over here, actually, if you are looking at it on a constant currency basis, they are actually growing at around 38% year over year. However, I think what is very impressive is their gross profit margins over here. They have maintained a strong gross profit margins of over close to 60 or even over 60% in some quarters. And I think this is something that is going to really strengthen the company going into a more volatile and uncertain environment in the next couple of years. Now, like I said, net income is slightly less reliable because of a lot of changes to the net income number due to the cash that they held on their balance sheet that are in US dollars. And so as the US dollars is being devalued, that's going to affect their net income, which was what happened in the most recent quarter. So despite in Q2 of 2025, they missed their EPS targets, but the reason why they missed is because of the foreign exchanges and nothing to do with their core business, right? So right at the bottom, what you're going to be able to see is the cash flow from operations and their free cash flow positive. Now, I just want to point out over here, in Q1 of 2025, they actually came in free cash flow negative. So for a moment, I felt that was pretty worrying because that suddenly disrupted the trend of growing free cash flow. Later, you're going to see the graph over there. But I just want to take a quick moment to explain what I found out. Now, during the Q1 2025 earnings call, management also addressed the fact that because they had a lot of inventory going out during that particular quarter, what happened is that they had a large amount of account receivables, right? So when they actually pass on all of their shoes to the wholesalers, it is immediately recognized as revenue. However, cash payment hits their bank account 30 to 90 days after they have shipped out their shoes. And so because of that, that is why we see a negative impact to their free cash flow. But I think apart from that, the free cash flow later on, you're going to see the graph has been growing over the last couple of quarters. So let me zoom it out a little bit. And this is basically their... Okay, so the first graph that you're seeing over here is their revenue growth. Now, revenue growth has been basically straight up for most of the last couple of quarters. However, growth rates has slowed coming into 2024. Now, throughout 2024, they have managed to re-accelerate growth. But once again, in 2025, largely due to the foreign exchange concerns, growth rates basically fell back down to the 32% range. But if you remember our framework, we are just looking for companies growing above 30% to be considered a hyper-growth company. for that matter, say that right now they are still considered just about a hyper growth company, right? Operating income has been pretty strong. It was fairly consistent, and you can see, that there always tends to be a little bit of a bump towards the end of the year, right? So I'm expecting to see that for this year as well. And then net income, which is pretty lumpy. Like I said, you can't really use this as a good measure because a lot of this can be affected by a bunch of different factors because this company isn't in the US and they hold a lot of US dollars on their balance sheet. And so that's why free cash flow is a lot more reliable. And what you're seeing over here is that they have been free cash flow positive most quarters. They had certain inventory issues in the Q1 of 2025 regarding the accounts payable. And when the accounts receivable are basically not realized as cash in that quarter, they can't report it as cash. And that's why they were free cash flow negative over here, right? So I think because of that, I can accept this reason for being free cash flow negative as long as it doesn't happen too often and basically to see them continue to rise. But in Q2 of 2025, we can start to see free cash flow normalize once again, and I'm hoping to see this accelerate into the end of the year. So with that, if you take a look at the DCF, give me a minute. All right, so the DCF that we have over here, what we are doing is that we are expecting a 31% year-over-year growth, right? Why are we expecting a 31% year-over-year growth? Well, because that's what management has told us in their expectations for 2025. So because of that, we are expecting a 31% year-over-year growth. Now, thereafter, the assumption is that the growth will start to slow down a little bit in the next few years, 27, 25, gradually slowing to around 20% by 2030. Right, cash flow margins I expect to stay relatively constant, around 22%, and then slowly increasing to 25% towards the end of the decade. I think as the business gets a little bit bigger, I think it's normal to expect them to expand their cash flow margins. Now, capex spend has been pretty consistent, and you can see in the mid 2% range. So I'm going to change this to 2.5%. Right, 2.5%. And then perhaps dropping to 2% towards the end of the decade. All right, what I haven't put in is actually the cash position and the debts that they have. Let me go. And so let me take a look at the cash and debt that they have on their balance sheet. So if I look at their balance sheet, cash and equivalents over here, and long-term debt. Sorry, I want to look at it. I want to look at it on a quarterly basis. Sorry. Yeah, so you can see cash and equivalents very strong, around $846 million. All right, that's cash and equivalents. We don't count restricted cash. Yeah, $846 million. Long term. Yeah, I don't see any long term debt. Do you have? Option. Nope, they don't. All right, so basically, they have around $846 million in cash. Let's put that into our valuation. $846. It was point something, right? Let me just be accurate over here. 846.6. Okay, number of shares outstanding. They account for us. Share price around $85. Now, EBITDA margins. Okay, we know that their long-term EBITDA margins is around 20%. So I'm going to use 20% over here. That increases it slightly. Okay, so I think you can see a fairly big difference between the perpetual approach, which values it around $85 per share, and the multiple approach, which makes me think that maybe my multiple might be a little bit too conservative. So if I go back to fiscal.a and take a look at the ratios, what you have. Right. Okay. So currently, their forward EV to sales for 2026 is around 17 times. Oh, sorry, I'm not sharing my screen. If you see over here in their forward valuation, you can see that their forward EV to EBITDA, yeah, and it hasn't even been trading at 10 times before. So perhaps I've really been too conservative with my expectations. Right now, EV to EBITDA around 17 times. Okay. So not too concerned. Let's just see norm EV to EBITDA. Not the forward one. That's normal EV to EBITDA. They don't have for this. That's strange. Let me see on another website. Wow, okay. Their EV to EBITDA is actually quite high because price to sales EV to EBITDA around 36 to 42 times. Okay, I'm looking at June, so June's data. 36 to 42 times. Wow, okay. So that's actually pretty high. So perhaps I will, no wonder the valuations here are a little bit wonky. I think I'm just going to use 15 times if that is the case. And I think that is where, you can see that with that, the valuation actually, is more or less in line. I think sometimes when you look at the valuation process, you have to understand why is there a difference and then to actually look at your assumptions again. So I have 10 as my EV to EBITDA assumptions. Usually that's fairly conservative, but for a company growing as fast as them, if they can still put up 20% revenue growth, then 10 times EV EBITDA, slightly lower than where it is today, is definitely something that is pretty viable for them. With that, you get average implied price of around $83, right? Which means that if you take, for me, I'm going to give it a 15% margin of safety. 15%? What am I accounting for? Well, I'm accounting for tariff risk. I'm accounting for foreign exchange risk. And yeah, I think that's about it. Right? I think management has been pretty solid. Their execution has been pretty solid. 15% seems about right. With that, you can have a price target today of around $71.24, which represents a 58% upside, which is actually pretty decent returns. But that is only if you believe that these growth rates can play out. Now, of course, if you're worried about a recession, and let's say you're worrying that growth next year slows to 20%, and then only coming back later on in the decade before once again slowing down, well, I guess you kind of get more or less the same, slightly lesser. So this assumes the recession next year, growth falls to 20%, and then goes to 23, 25, and then you're basically slowing back down to 20%. Now, let's say when growth slows, margin slows as well, 23, and then you start growing 25 towards the end. Well, you don't have much difference there. So with that, you can see that even at a 15% margin of safety, this represents a pretty decent returns, around potentially 51% returns, depending on your assumptions. So this is where the DCF actually makes sense. I don't like to use the DCF as a way to give me an answer, but I like to use the DCF in a way that helps me check my assumption over there. Right? So like earlier on, when we found out that there's a huge discrepancy between the perpetual approach and multiple. Yeah, we actually go back and actually find out what's the difference. Now, with companies like Oscar in the past, or even I believe New Bank and things like that, sometimes there are just these discrepancies because certain companies are newer, or the way that certain segments of the industry is being valued. But for On Holdings in particular, we can see that when we actually check our assumptions, 10 times EV to EBITDA, that is actually way too bearish, because they have never traded at that valuation before. That's the first thing. And secondly, if they are putting up 20% growth, even 15% growth, I don't think they should be trading at 10 times EV to EBITDA, right? So that's why 15 times, right, future EV to EBITDA, if you consider the fact that they're currently trading at around 36 to 45 times EV to EBITDA, I think that's a fairly conservative approach, right? Which means you're expecting the valuation to compress by nearly 60% over the next 5 years, which means you're expecting their earnings to grow by a similar amount in order to put up the numbers, in order for the share price to increase. So I think that is a pretty healthy valuation, end up with around $68. And with that, let's take ONS into the framework. Before we continue into the framework, is there any questions? All right. So with that, let's take ONS into our framework. I think maybe not ONS. Yep. I think for those of you who just joined the stream, basically ONS is a sportswear brand. They position themselves in the premium segment of sportswear and apparel. Their main competition are companies like Lululemon and Nike, right? And so what they have done is that they have basically shown us that they're able to grow revenues fairly consistently. Of course, there are certain things in the macro environment that could affect their business, things like tariffs and things like basically some of the foreign exchange, but nothing has fundamentally affected their business. But their price has been volatile in the most recent few quarters, largely because of all these macro conditions and the fears around these things that are completely out of their control. Now, ONS themselves as a company has taken steps to actually mitigate some of this. You can see that they have diversified their revenue stream. In terms of their sales mix, it's a fairly healthy 40% direct consumer, 59% in the wholesale side, and that basically helps them to increase their margins as they increase their reliance on direct to consumer models. Now, if you looking at the segment of their business, the footwear makes up around 80% of their overall revenue, but within footwear itself, they have 9 main lines of shoe franchises, like different lines of shoes that actually make up 50% of the revenue, 45 to 50%, right? Each one contributing 5% of revenue. So they are not diversifying by the number of verticals, but within one verticals, they have 9 different solutions at least, right? So that is their way of diversifying. And then as well as they have their light spray technology, which we have spoken about right at the end. What this does is really helps them to gain control over their supply chain, because this light spray technology allows them to automate their manufacturing process, and it basically allows them to move manufacturing back to Switzerland, to the US. Because of that, that actually can be a protection against tariffs and some of the uncertainty and volatility of policies within that region. And so I think if we are looking forward in terms of growth, America seems to be on the slower side. However, Asia is starting to pick up. Asian Pacific year-over-year growth has been around 101%, and I expect that to continue with them opening up their 100th store in China in 2026 in Chengdu. That is going to be their flagship store, and I believe we are seeing more and more demand in some of the more affluent parts of Asia regarding this brand, especially people who are in tennis and golf, which are usually sports that are associated with more affluent people, right? And so with that, let's take ONS through the framework. Is the TAM 10x of revenue? Definitely right now. Now, the TAM is not growing at a fast pace. And I'm not going to give them full marks because they're not really coming out with new verticals. I acknowledge that they are diversifying within one vertical, but they're not doing anything that is new. So 1 point over here. So to explain, yes, in a sense, their business model is simple to explain, right? You make shoes, you sell shoes, they actually have a high gross margin. So there's no switching cost, no mode for switching costs. Network effects, I would say, well, did I give network effects for Nike? 0.5, right? Network effects, I guess in terms of the number of stores and all that. Yeah, okay, I'm going to give them points for network effects because it's not a clear mode yet because they're still small, but I can't fault them from being small. I think relative to their size, they're getting their brand out there into retailers and things like that. Network effects definitely have. Low cost advantage. This is something that I'm going to give to them, especially if they are able to roll out the light spray technology at scale in 2026. So right now, I'm just giving them half a point for strengthening and clear mode, but not insurmountable. If they actually manage to roll out the light technology, increase this one. If they are not able to, if it gets delayed to 2027, I will be cutting this down to 0. Economies of scale, yes, they do have a regulatory framework. Like I said, similar to Nike, I'm giving 0 here because they are prone to some of the regulatory changes. So it's not really a moat for them. Intangible assets, I think at the moment, people may kill me over here, but I'm going to have to say weak mode because I think not a lot of people know about them. They are growing. And recently, I believe I saw this study where they only have around 1% of the market. Now, it means potential for growth is there. And I'm not saying that they don't have a moat. I'm just saying the moat is weak. Because if you only have 1% of the market, I don't think I can say that it is strengthening, right? Eventually, I think as they get a bigger share, closer to the Puma. And okay, let me pull up this graph for you. And then if you really disagree with me, you can let me know. But let me pull up this graph for you. I believe I shared it during the Nike live stream. Okay. It's over here. If you look at this over here, you can see Nike have around 15% of the market, fell to 14%. ONS, yes, ONS grew their market share. If you want to put it very nicely, it grew by 25%. But technically, they just took 0.2% of the market. So I think sometimes when we are excited about the company, we like to say it's growing very fast because that's what the management tells us. Now, 25% is a very fast-paced growth, but objectively, you're only getting 0.2% of the market. So I don't think it is fair to say that because some abroad 1% market, then you can have a strengthening mode. Now, I think if they overtake the smaller companies like New Balance and Puma, or at least reach their level, and I think at that point, I will be a lot more inclined to be giving them more points in terms of their branding, right, as a moat. Right, so let's go back to... Okay, and then from here, is revenue growing faster than TAM? Definitely. Revenue hyper growth? Yes, I think over the last couple of quarters, there were 1 or 2 shaky quarters, but you can see in the most recent quarter, even with all the disruption, 42%, 38% on a constant currency basis, that's not too bad in terms of revenue growth. One dominant revenue stream with 1 or 2 smaller bets. Yes, okay, I'm going to keep it there because footwear is still, I mean, they have different verticals within footwear, but it is still footwear. Right? If one day they lose their patented technology, people copy them, that risk. If people just don't like their footwear anymore, that's also going to be a risk. No customer accounts for more than 10 to 15% of revenue. That's fine. High gross margins. I'm going to give this to them. They're definitely higher than average at 60%. They are the highest, I believe, compared to Lululemon and Nike. And strong cost control with low fixed costs. I think they have shown that. And I think especially if they can roll out light spray towards the end of 2026, we are going to see that increase even further, right? Debt management, they are definitely net cash, no goodwill. And so this is, they get full marks over here. They are free cash flow positive. They are, yeah, positive and growing. I think we will, for now, because it has only happened once and management has a good explanation for the reason for the drop in free cash flow in Q1 2025. I'm going to let them pass, but I don't think that this is something that I am. I don't want to see this happen to them, right? That because of accounts receivable, your free cash flow becomes unpredictable. Are they buying back shares? No, they're not buying back shares, are they? Okay, they are not buying back shares. At least there's no information of them buying back shares. Okay. How about inside? All right, so they're not buying back shares. They have pretty decent insider holdings. I mean, the founders are all still there. They're not serving on. They're not serving necessarily as the CEO and things like that, but they're still part of the board. So I'm going to give them points for that. Founder-led experience, mission focus. I mean, founders are still on board. The guy running the company is running the company because he's good at running the company. I mean, he scaled their business up from hundreds of millions to multi-billion dollars, right? So I would say that it's not founder led, but they have an experienced CEO, mission focus. I don't know. I think at the moment when the founders are still there, when Oliver Bernhardt is still the one at the heart of the product development, we have to say that they are still visionary. There's still a visionary leader there, and he's still mission focused. They are just letting someone else run the business. I find this a little bit harder to give one to compared to Oscar. Because with Oscar, there's so much information about the handover between Mark Bertolini and Mario Schlotzer. However, for this, I'm still inclined. Okay, personally, I would say experienced CEO, good track record. That's what I feel about the company. Maybe because I don't know Oliver Bernhardt enough, because I don't know enough about this company, but I know that the CEO is very good from an operational point of view. Whether or not he is the one to take the company forward in terms of a visionary point of view, that remains to be seen, right? So, I think I'll take half a point away from that. Now, they have no debt, so nothing to do there. Exit unprofitable segments. Do they have unprofitable segments? No, they don't. Diversify. I think they are actively working towards that. Simplify operations, also actively working towards it. So it's not like they have nothing to do. Improve liquidity. You do no unnecessary M&A, nothing to do. Core business can survive downturns. They haven't shown that they can profit during downturns, but survive, yes. 5-10 years, survive one bad market cycle. Okay, not bad. With that, On Holdings actually get a score of 26.3, pretty respectable, somewhere in the middle. It's story driven. I think, like I said, if you believe the Asia Pacific growth story, if you believe in their ability to use light spray technology to lower costs and to continue to scale their manufacturing processes, then I do think that this company definitely has room to grow. Now, if you take a look at the market share component, that is where where you really put things into perspective. Right now, they're able to grow because they're only having around 1% of market share, so which is not really a significant dent in the overall entire market. I think people are saying that this company can potentially on and I don't think it's that easy. They do have to expand their product beyond the premium range in order to take on a Nike, I feel, right? And if that is the case, how they actually implement some of these cloud tech technologies downstream into the other segments of the markets, how they actually manage to maintain margins, I think it's not as easy as people make it out to be. I think now they are having high gross margins because they are charging premium prices. But if you go more downstream in terms of the market that you're going after, I really don't know whether or not they can still maintain margins at these levels. Perhaps with their light spray technology, they can. And if they do that, then I think they will be worth their valuation. But then you really have to believe the story over here. right? And so with that, yeah, I think that's where we'll call it a day tonight for the review on ONS Holdings. I think I just want to make a quick note over here about Lululemon. Uh, I think with Lululemon, I think what we are seeing is really fears over because Lululemon, in terms of their stock, that has declined quite a hefty amount. I can't remember how much it declined. I actually have Lululemon puts right now, and I didn't buy puts. I sold puts on Lululemon to buy it at $190. All right, I just want to speak about this very quickly because I told some of you that I'll be talking about it later on, and I've made reference to it throughout the video. But I think I just want to show you Lululemon and what I'm doing with it right now and why I have actually sold cash account puts. Now, I think for ONS, oh no, this BMNR, okay. Options premium went down. I was expecting to get closer to 80%. Anyway, that's a different story. Okay, let's take a look at Lululemon. And I think what we are seeing with Lulu is that, oh, it's been a huge drop. Where was the high? High was, it's been is it a 60% drop? Close to a 60% drop. And I think this 60% drop is really largely down to fears over, yeah, Samir, I think I'm the same. I tend to stay away from apparel. I'm only running a swing on Lululemon, and if I don't even get assigned the shares, I'll just take my premium and run next month. Sorry, I'll show you the setup later on. But I think for me, this shows me the upside, right? Because people are expecting Lululemon to completely stop growing, but I think once again they are really discounting Asia Pacific markets because if you are in Singapore, everywhere you turn, any girl who is doing any sort of exercises, they have Lululemon. So to me, I feel like perhaps the American market is saturated because that's where they started most of their expansion, but now they're getting into the Asian markets. And I think it's quite interesting because I don't know, is it the way that their sales reps are being trained? Now, recently I bought something from Lululemon, went to the shop didn't have my size. Now, usually sometimes they will try and book it for you, reserve it for you at another outlet, and then you just go to that next outlet and collect it. But instead, what they did was that on the spot, they made me order it online, sent it to my house directly so I don't have to come and collect it again. And I think that is how they train their sales staff to do sales in general. And so because of that, you can actually see that yeah, it really has it. Because otherwise that would have been a sale that they would have missed out on. And I think for me, I think the brand name of Lululemon, I can tell, at least in Asia, still holds a lot of weight. I think people feel like, oh, perhaps they're losing its appeal and things like that. But I think in Asia, at least in Singapore, definitely it's still seen as a premium brand and much differentiated from companies like Nike and Adidas. Now, personally, for me, I don't have a big stake in this. If you see over here, all I have basically two cash account puts. Now, my average was around $8.70, so made about $1.10 over the last day. So basically, I've sold 20 of this, two of this at $190 for $8.65, which means I get around what, 1,007 in 3 weeks, right? These expire on 19th of September. Best case scenario, no, I wouldn't. Case I don't even know what I really want from this. I'm hoping to ride it up to 300-ish. That's about it. So for me, not too keen in apparel companies because of the inherent risk, because of all these foreign currencies, volatility. But I'm okay with the valuation of Lululemon because I think it is severely underpriced. People are misunderstanding the Asian markets. Whereas for ONS, it's a bit harder for me to want to get into ONS because it is a growth story. And I need to believe that you can beat some of these incumbents. And I need to see that. I need to see evidence of that. And right now, they are only at 1% market share. Whereas for Lululemon, they have already shown that they are the premier brand in terms of premium sportswear and apparel, at least for me, I think that right now I can see them recovering some of. I mean, everyone goes through periods, lull and periods where perhaps their items are not as desired, and I think that's normal for every brand. And I think for me, it's easier to spot a lull in a cycle, in a fashion cycle, rather than to point out, oh, this is the next company that is going to create the next best shoe that is better than Nike. Because especially if you think about how ONS structured their business, the whole cloud tech technology, I'm not too sure whether, I think it will appeal to people who are, very into sports and very pro athletes. But I think for the average person, they are still likely to go towards Nike and Adidas. And in Singapore, especially, I think Lululemon is really getting to become popular. And Asia Pacific, like I said, is a large market. China has over 1 billion people. And a lot of this market is still untapped by all these brands, right? Because a lot of them started their business growing in the US, growing in Europe. And I think now they're starting to come over here. So I think because of that, for me, Lululemon, I just sold some cash account puts. If they get a sign, I get a sign. I'll sell covered calls. If I don't get a sign, then I'll just keep the premium. Now, I'm not going to wait until expiry. I'll probably wait until sometime early part of September. If I can realize around 70, 80% of this, then I'm going to close it. Because I think Lululemon, right now, there's a lot of negativity around the company because they also lowered their full year EPS guidance. Inventory has been building up. And I think, this might be a case of Nike, right? Where they just need to refocus their company. They already have the things in place to run a profitable business, a profitable cash flowing business. It's just going to take time. Whereas for ONS, they are needing to put the things in place. They need to bring their brand out to the consumer, and then they need to go further down market. And I really want to see their margins and how they conduct this, or how they actually roll out this expansion before I decide to open a position in ONS. And so with that, I think we'll call it a day for the streams, and I'll see you tomorrow where we'll be talking about Affirm. Is there any questions before we end the stream? Right, thanks everyone for showing up. I know some of you were asking about Discord and things like that earlier on. Like I said, that will be perhaps end of the year, early next year kind of thing. I think I'm trying to get into the rhythm of creating live streams, putting out content on a more regular basis, and then definitely creating a Discord, something that we can exchange ideas and things like that would be the plan in future, but that will be a couple months down the road. All right, so with that, I'll see you in the next one.